What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Ryan Pulis here with another episode of the CPA Zone. Last week, we talked about dealer versus investor status and the criteria the IRS uses to classify taxpayers as a dealer or an investor. So this week, I wanted to mention a section of the code that helps some non-dealers keep capital gain treatment on the sale of certain real estate sales of subdivided property. So as a refresher, remember that a real estate dealer holds property primarily for the sale to customers in the ordinary course of business, while a real estate investor holds property primarily for investment purposes, expecting some appreciation over time. So dealers they hold property, their real estate is treated as inventory held for sale, and investors own capital assets. So real estate dealer income is taxed as ordinary income, subject to self-employment taxes, while investors, their income from the sale of capital assets are taxed as capital gains, generally at the more favorable rate as long as they own the property for at least a year. And there's no self-employment tax on capital gain property. So there's seven factors we talked about last week. These are called the Winthrop factors that the IRS uses to determine whether a taxpayer should be considered a dealer. One of those factors looks at the development of property, including subdivision. Another factor looks at the advertising and marketing of the property for sale. So both things, subdividing a property and advertising or marketing that property, they tend to point toward dealer status. Now, again, all seven factors are looked at. No one is really indicative of, or not one factor alone is going to make you a dealer. But there's Section 1237 that says a taxpayer generally does not hold property primarily for the sale to customers in the ordinary course of business, meaning they're not necessarily a dealer, just because they subdivide the land or market it for sale. So therefore, a property owner that subdivides their property and has some sales activities or does a little bit of marketing might still be able to realize capital gain on the sale of those lots. So they have a tract of land, they subdivide it into smaller lots to sell it. That can still qualify as capital gains if you meet three conditions. So those three conditions are: one, you must not have previously held the property for sale as a dealer. So this automatically, like if you're a dealer by trade and you own this property, you're not gonna qualify into Section 1237. Two, you can't make any substantial improvements to the property that significantly enhance its value. So again, one of the Winthrop criteria looks at the improvements made. So if all you're doing is subdividing the land into smaller lots and selling them off that way, you're not making any improvements, then you can still qualify under the Section 1237. So you're not making any substantial improvements to the property. Now, certain necessary improvements, like if there's an improvement that needs to be done to get the property ready for sale, those are allowed, but you can't substantially improve the property and increase its value. And then the third criteria is you must have held the lot for at least 5 years. So if you remember from last week, one thing that has weighed in the IRS consideration of dealer versus investor is the length of the holding period. Longer holding periods tend to lean more to investor. So in this case, under Section 1237, you have to own it at least 5 years. Now, even when these conditions are met, if you sell more than 5 lots, you're generally going to recognize some ordinary income that's going to be equal to 5% of the gain on all lots sold after the year in which the 6th lot is sold. So this is called the 5% rule. So you sell more than 5 lots, whatever year you sell a 6th, going forward, you're going to have ordinary income equal to 5% of the gain. So that year, it starts the year the 6th lot is sold. That year and going forward, you're going to have this, you're going to be subject to this 5% rule. 5% of the gain will be taxed as ordinary. So what Section 1237 is telling us is that as long as you are not normally a dealer and you don't substantially improve the property, you own it for at least 5 years, you may be able to qualify for capital gains treatment on the sale of property you've subdivided. So I thought this would make a good follow-up to last week's episode where we talked about dealer versus investor status. So now we're going to get into a little bit of Q&A. A couple questions came in that are actually related to the last week's topic and this week. So let's go. First question is, if I fix and flip only 1 or 2 properties a year, am I safe reporting that income as capital gains as an investor on Schedule D rather than having it taxed as ordinary income like a dealer? Great question. So this answer takes us back to the Winthrop factors. And there's 7 in total, 2 of the most important being the number and frequency of sales, as well as the original intent of the purchase. So with 1 or 2 flips a year, obviously you're low on the number and frequency of sales, but your original intent comes in as well. So if you intended to buy the property and resell it, you're fixing it up to resell it to a customer, then that's going to point towards dealer status. Now, there's court cases out there where a single sale in a year is resulting in dealer status, and others where there's been multiple sales that's still qualified as investor status. Now, from a practical standpoint, if you do 1 or 2 flips a year and treat the income as capital gains, you're not likely to be flagged or treated as a dealer, especially if they're not huge deals with large dollars. But it is possible if the IRS came in and audited your return, if you were examined, they could take that 1 or 2 fix and flips based on your original intent and get all the other factors and potentially treat it as dealer status where you're going to be taxed at ordinary income. So there is some risk there if you're reporting it as capital gains, but with 1 or 2 a year, you are one of the main factors. You're low on that number and frequency of sales. So now on to question 2. This person asks, if I use the BRRRR method and eventually sell my properties, am I considered a dealer? This is another good question. So as a refresher, BRRRR stands for buy, rehab, rent, refinance, repeat. It's a value add play for single family homes where you typically hold the property as a rental for a period of time after you do the rehab. So a rental falls into the investor class. So your risk of being considered a dealer is extremely low, almost non-existent, unless you aren't actually renting the property, in which case you're not really doing a BRRRR strategy. So we're going to assume the properties are being rented. So when you eventually sell a property that you've used the BRRRR method on, it's the same as selling any other rental, and it's going to be taxed as capital gains generally, where you're an investor rather than a dealer. The fact that you did improvements, which is one of the Winthrop factors, that's not enough by itself to have you considered a dealer because you're renting those properties out, you're seeking cash flow and appreciation, so you're an investor in that case when you're doing the BRRRR method. Now that about does it for today's episode of the CPA Zone. Thanks for listening, and I hope you found something valuable you can take away. If so, please hit that like and subscribe button and leave a 5-star review. Until next time, thank you.
This audio segment was edited by me, Adam Rothstein. If you would like help editing your podcast or narrating your audiobooks, please email me at adamrothstein29@gmail.com. That's ADAMROTHSTEIN 29@gmail.com.
So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.